Ever wondered how the pros pick winning stocks? It's not just about luck, it's about understanding the numbers. Just like you wouldn't buy a house without looking at the price per square foot or the debt-to-income ratio, you shouldn't buy a stock without understanding its financials. In this video, we're diving deep into the 10 most useful ratios in the stock market that can help you make informed investment decisions. These ratios will give you X-ray vision into a company's financial health, helping you spot potential red flags and identify undervalued opportunities. So, grab your notepad and let's get started. The price-to-earnings ratio, or PE ratio, is one of the most fundamental ratios you'll encounter in the stock market. It tells you how much investors are willing to pay for every dollar of a company's earnings. Think of it like this. Imagine two lemonade stands, both selling lemonade for $1 a cup. One stand made a profit of $10 last year, while the other made $20. Would you rather buy the stand that made $10 or $20 in profit? The PE ratio helps us compare the price we're paying for those earnings. If the first stand is selling for $100, a PE of 10, and the second stand is selling for $150, a PE of 7.5, the second stand is actually a better deal. A high PE ratio could mean that investors are expecting high growth in the future, or it could mean that the stock is simply overvalued. Conversely, a low PE ratio could indicate an undervalued stock, or it could signal underlying problems within the company. The price-to-book ratio, or PB ratio, is like treasure hunting for undervalued stocks. It compares a company's stock price to its book value, which is essentially its net worth, if it liquidated all its assets and paid off all its debts. Think of it like buying a used car. The book value is like the car's Kelley Blue Book value, what it's technically worth on paper. The market price, however, is what someone is actually willing to pay for it. A PB ratio of 1 means that the stock is trading at its book value. A PB ratio below 1 suggests the stock might be undervalued, like getting a deal on that used car. On the other hand, a PE ratio above 1 means the stock is trading at a premium to its book value. This could be because investors are optimistic about the company's future prospects, or it could be a sign of overvaluation. For those of you who love passive income, the dividend yield is your new best friend. This ratio tells you how much cash you'll receive in dividends each year for every $100 you invest in a stock. It's calculated by dividing the annual dividend per share by the current stock price. For example, if a company pays an annual dividend of $2 per share and its stock price is $50, its dividend yield would be 4%. Think of it like owning a rental property. The rent you receive is like the dividend, and the yield is like the rental yield you earn on your investment. Remember, while a high dividend yield can be tempting, it's crucial to consider the company's overall financial health and dividend sustainability. The debt-to-equity ratio, or DE ratio, measures a company's financial leverage, which is essentially how much debt it's using to finance its assets. Think of it like buying a house with a mortgage. The larger your mortgage, the higher your leverage, and the riskier your financial situation. A high DE ratio means the company has a lot of debt compared to equity, which can be risky, especially during economic downturns. If the company struggles to make its debt payments, it could face financial distress. On the other hand, a low DE ratio suggests the company is more financially stable and less reliant on borrowed funds. It's important to compare companies within the same industry because some industries naturally have higher debt levels than others. The return on equity, or ROE, is like the MVP of profitability ratios. It tells you how effectively a company is using its shareholders' money to generate profits. Imagine you give $100 to two friends to start their own businesses. One friend returns after a year with $110, while the other returns with $120. Which friend would you rather invest in next time? The ROE helps us identify the friend who generated the higher return on your investment. It's calculated by dividing net income by shareholder equity. A higher ROE indicates that the company is more efficient at generating profits from its shareholders' investments. Remember, a consistently high ROE is a good sign. but it's important to consider other factors like industry averages and the company's growth prospects. The current ratio is like checking a company's wallet to see if it has enough cash on hand to cover its short-term obligations. Imagine you have a stack of bills due next month. Would you rather have $1,000 in your checking account or just $500? Having more cash on hand provides a safety net and reduces the risk of missing payments. The current ratio measures a company's ability to pay its short-term liabilities with its short-term assets. It's calculated by dividing current assets by current liabilities. A current ratio of 2 or higher is generally considered healthy, indicating that the company has enough liquid assets to cover its short-term debts. Remember, just like with personal finances, maintaining a healthy current ratio is crucial for a company's financial stability. The quick ratio is like the current ratio's more conservative cousin. It takes a closer look at a company's ability to meet its short-term obligations by excluding inventory from its current assets. Think of it this way. If you suddenly needed to pay off some debts, would you be able to quickly sell your entire inventory? For some companies, selling inventory quickly might not be easy. The quick ratio, also known as the acid test ratio, only considers the most liquid assets, such as cash, marketable securities, and accounts receivable. It's calculated by dividing quick assets by current liabilities. A quick ratio of 1 or higher is generally considered healthy, indicating that the company has enough liquid assets to cover its short-term debts without relying on inventory sales. This comparison can highlight companies that might be facing inventory management issues or have a higher reliance on inventory to meet their short-term obligations. The inventory turnover ratio tells you how efficiently a company is managing its inventory. It measures how many times a company sells and replaces its inventory over a specific period, usually a year. Imagine 2 retail stores selling the same product. One store replenishes its inventory every month, while the other takes 6 months to sell its stock. Which store do you think is managing its inventory more efficiently? A higher inventory turnover ratio generally indicates that the company is selling its products quickly and efficiently. Remember, a high inventory turnover ratio is generally desirable, but it's important to consider industry norms and the company's specific business model. 10 most useful ratios in the stock market and their importance in making informed investment decisions. Remember, these ratios are like financial detectives, helping you uncover hidden clues about a company's financial health, profitability, and growth potential. Use these ratios to analyze stocks and make smarter investment choices. Don't rely on luck or gut feelings alone. By understanding the numbers, you'll be better equipped to navigate the complexities of the stock market and make investments that align with your financial goals. Don't forget to like, subscribe, and check out the links to financial news websites and investment tools in the description. Happy investing!